Hello and welcome back. In the last training video we talked about the three major core disciplines that exist that the vast majority of traders are using to trade the financial markets. If you remember, they were breakout trading, retracement trading and level trading, and we discussed a little bit about how to take advantage of level traders, but we didn't really get into the detail of the strategies, and I'm going to share with you two of my favorite strategies to trade off a level. So let's dive in. So just like before, we want a level that's been touched several times. So in this case, it's touched twice and price is now coming in for a third time. As price comes into the level, traders are going to look for some type of reaction off that level because they've done that historical analysis and hopefully they believe that it's going to bounce off that level and give them the opportunity to take a trade. So it does indeed bounce, and you get one candle that goes in the direction of the move that they believe will go to the other side of the range or higher. So we get 1, 2 candles in the direction of the move. The point is that it's the early stage of that move, because if you think about it, at some point the trader's going to have to come in and commit some capital. They can't wait until price is up here because they've missed the move. So they're going to have to come in this first 1, 2, 3 candles. It's not really any more than that. It just depends on how it reacts. Sometimes you can get a big engulfing candle at the level and that will get a lot more traders in one go. It just depends. But although it's aesthetically slightly different all the time, it's always the same. So I refer to this occurrence as entry cheese, just like a mouse, right? Gets tempted in by some cheese and then boom, gets trapped. Traders get tempted in by price action at the hard right edge, right? So this is what we talked about the other day in the other video, where traders don't pay attention to what's coming in the future, right? The hard right edge. What happens is they get super focused in the here and now. And because we know that they're either a breakout, retracement or level trader, it's easy for us to deconstruct their trading strategies and see where they are on the chart. So price comes into the level, starts to bounce off, the hard right edge has created this illusion and so's the entry cheese, and then it's very typical the behavior from there on in of those traders, because what will happen is as price bounces off the level, let's say 2 candles bounce off the level, what happens is the trader will look, and perhaps this is a range, and they'll put a take profit order usually just in front of the range, and then they'll place a stop loss just below the level itself, right? So if you were to be able to have a look at the orders, what you'd see is like a peppering all under that level. And the more the level's touched, the more peppering will occur, more people take the trade. That's why I said that you need to really have a minimum of 2 touches every time you look at these setups. The more the merrier, because the first touch into that level, not so many people took that trade, but as the level actually progresses and you get 2, 3, 4 touches, etc., more eyeballs are on it. So if more eyeballs are on it, then more people are going to take the trade because it's more obvious. And as a consequence of that, if more people are taking trades, then there's going to be more stop losses accumulating above or below these levels. So the trader goes in. At this point, I don't want you to do anything, right? I just want you to be an observer of this. So you see that traders are taking the trades, but now what we want to do is just sit back and watch as price goes against them. Now, it may not happen. It may follow through and it never turns into a trade, but we just sit back and just relax and just let it play out. But if it does happen, then we want to take advantage of that. So as price comes into the level, bounces off it, 2 candles, they believe it's going to follow through, then we get a negative candle against those traders. Now, what we want is we want the level to clear, because we don't want this to be a stop hunt. And I'm going to show you how to trade a stop hunt in a moment, one particular type of stop hunt. But this we don't want that to happen. We want it to follow through. Now, how do we know if it's followed through? What we need is 1 candle, then a second candle. So 2 candles is the setup. So now we have the setup to close, open, high, low, close beyond the level, no intersection of the level. So what I mean by intersection is where you've got the candle still touching the level, well, you know, maybe several candles. That's not what we want. We don't want that. We want it to clear the level like that. And at that point, we're in the position where a trade can be taken. We just need some type of pullback into that level. Or it can be shy of the level, makes no difference really. But if it pulls back into the level, these traders who are trapped, you can be fairly certain what they'll do if price comes into here. They'll start to bail out at break even, right? Second best trade in the book. And if they're still in the trade, if they never got stopped out below that level, they'll exit manually as price comes back in. Now, if they were a buyer off that level, believing that's going to head up, then as it comes into that level on a pullback, they must sell to do that, right? It's always the opposite transaction to the one you took, whether you're taking profit, getting stopped out, etc. So if it comes back, after you get the 2 candles set up, comes back into the level, you know there's going to be supply there because those traders are going to bail out or break even, creating supply. It's forced supply, so buying and selling is usually just described as that, or supply and demand is just described as that. It's never described as forced, and a lot of it is forced through taking profit and definitely through taking stop losses. So these buyers, they realise they're in trouble as price goes against them, it comes back and they'll bail at break even, and that creates supply. You're also going to get break pullback traders, right, who are trading off the underside of that level, more selling. And if these traders did get stopped out, then that's more supply anyway, it's just been triggered automatically. So as price breaks down, we get 2 open high-low closes beyond the level, it pulls back, and we get 1 candle in the direction of the move that we want to go, so i.e. down. As it closes, the second candle opens and breaks the low of that first candle, then we go short. Take the short, put our stop loss above the trap, up in here, and then go for a minimum of 2 times risk. So if you risk 50 pips, you want to go for 100 pips in profit. If you risk 100, you want to go for 200. And the reason we need these 2 candles to clear the level is so that we don't get stop hunted. You may have come across a break pullback setup before. It's not the same thing, because a break pullback basically just says sell as price breaks that prior level. The problem with that is there's no trapping element, there's nobody trapped. So when price comes back into that level, we know there's going to be people who sell in there because they went long buying off the level. So the subtle difference is there's no trapping at all that occurs just in here. So when it pulls back, break, pull back, it's just trading off the level and you're hoping people will sell, and that's not really that wise. So we always want people to be in trouble whenever we take the trade, right? We always want our opponents to be losing, to be weak, because no matter how you dice it, if you went long at the top of this candle and price is down in here, you're losing the worst amount out of everybody in that situation. But maybe you didn't buy the absolute high, maybe you bought halfway down. Right, you're not losing as much, but you're still losing. What if you bought on the second candle open? Again, not as bad, but still pretty bad. And then anywhere in this first candle, right, doesn't really matter where people bought in this entire structure. The bottom line is they're losing when price is down in here or in here. And the only difference was that they didn't wait, right? It's pathetically simple, but that's all that happened. They acted in a reactive manner at the hard right edge, right? So this is the hard right edge. They believed that what was historically had happened, they believed that it was going to occur again in the future, long enough at least for them to make some money. Otherwise, why would they take some risk in the first place? Right? You wouldn't do it. So they go in, we do nothing, right? We do nothing at all. We're just observing at this point, and then we just watch as price starts to squeeze them, right? Turn the screws, and then we've got an advantage over this group of traders. And any situation where I'm going to risk some of my capital, I want this in play, right? People losing money, obviously to varying degrees, but definitely losing. It's an unarguable point. You can't argue that point. And psychologically losing at the same time. But not only that, there's an order flow advantage to this situation as well, right? We understand that there's people going to bail out and that's going to create supply. We understand that people are going to trade that as a break pullback anyway, and that's going to create supply. We understand we're going in, so that's going to create supply, etc., etc. So that's the first setup. That's a trap break pullback, and I hope you get to take advantage of this in the markets. Now let's take a look at the second setup, which is a stop hunt. So what is a stop hunt? And is it real, right? The fabled stop hunt. Loads of people talk about it. Not many people understand it. It's like a bit of a conspiracy in the financial markets. Does it occur? Does it not occur? How do you take advantage of it? Can you see it on a chart, etc.? And the answer is yes, you can. I'm going to show you how to do that right now. So what is a stop hunt first and foremost? Stop hunts, it's not a conspiracy. It's more that it just has to work this way. The big banks and institutions, let's just say a bank, one bank, it's just easier to get your head around it. A bank needs to transact, right? And when they transact, they're transacting in huge quantities. But the problem is there might be a liquidity issue with that transaction, meaning there's not enough people to take the other side of the trade. So what that creates then is a problem for them because they're going to get hammered on costs, sometimes referred to as slippage. And that simply can't happen when you're trading with huge sums of money, right? So how do they get around this very real problem? Well, the stop hunt is how they do it. And let me explain. So you've got your level of support that's been touched several times. Now remember I was saying earlier about the density of the stop loss orders will build up the more levels touched, so there might be fewer on the second touch and even fewer people took the original move. So if that's basically the reason why there's less orders, because less people took the move originally. Now as a level becomes more obvious and clear, then more people are going to trade it and more people are going to place their orders. And that's very obvious, right? It's a very obvious thing. And people believe that the more levels touched, the stronger it gets. I'm sure you've heard that before, right? But really, the more levels touched, the more obvious your moves become, okay? And the bank, so we'll just describe it as a singular bank. The bank know this, right? They know this. So as price bounces off the level, right, 1, 2, 3 candles, right? Remember that, the entry cheese. Traders go in and they place the stop losses below the level. No sooner does it do that, it then goes down through the level, right? So let's imagine this is 2 candles that are broken down through the level. Second candle. Now, what's just occurred there? Well, first of all, if you're a big bank, and you want to take this trade as well, right? You want to be a buyer of this, right? Buy low, sell high. It's no different for the bank, but the problem is if everyone's buying, there's not going to be enough sell orders. So as price goes down through the level, that's forced selling. So these stop loss orders that built up at the level are being triggered. Now, if they're being triggered, the bank can get off some of its inventory. It can start buying into that selling, that forced selling through price dropping and triggering those stop loss orders. It's going to also seduce some people in. So this is order flow, understanding the order flow at the level. The people who didn't place stops there, maybe they placed them further away, and there'll be fewer of those people because people tend to manage risk or attempt to try and get close to levels. Those people will realize that the market's gone as it breaks down through the level, and they'll start exiting just manually, right? So what's that creating? More selling, right? It's good for the bank, gets off a little bit more inventory, right? It's got all these orders. These are buy orders. And in order to buy, a lot of buying, a lot of selling has to occur. So we've got 2 lots of selling going off. But guess what we've got now occurring as price breaks down through the level? Who's likely to do some selling now? Breakout traders. Breakout traders will trade the break of a level of support and resistance, especially one that's built up and been very obvious and clear. They'll think that the pop from that level is going to be like stronger than a normal, say, 1 touch level because of the fact that loads of people were trading it. So breakout traders pile in. Now then, imagine then that the next candle is actually a positive candle. And imagine that it comes back up to the level. What might occur next? Well, if there's a negative candle, maybe an engulfing candle or something like that, as it touches the level, the retracement trader is now going to go short. So we've got not only forced selling, you've got people who bought in here believing it would follow through, are exiting manually if they didn't get caught with the stop loss. You've got breakout traders doing more selling, and then as it pulls back into that level, so it's like a break pullback type of pattern like that, as it pulls back, retracement traders go short, believing the market's going to follow through off the underside of that level. What's that doing? That's seducing more selling. And obviously this can actually, this can be a little bit more elaborate. It can break the low even of that prior move. And what's that going to serve to do? More breakout traders of that structure, right? So if it breaks down below there, we've got breakout traders trading the breakout of that low. So if this pulls back and closes inside the level, right? So if you end up getting a close strongly back inside the level, then you want to go long and place your stop below the stop hunt itself, and make sure you go for a minimum of 2 to 1, but do so knowing that you're riding on the coattails of something. In this case, we're going to call this a bank, something massive that's just done a load of buying. So you want to be aware that you've just took a really smart trade. So net, the bank's ultra happy. All the buy orders that it couldn't get off in the first bit of selling, it ended up getting it all done by the time that people were forced to sell, by the time that people were seduced and induced in, it managed to get all its buying done, but optically it looked as if this was heading down. And that's the trick, right? That's the trap. People believe because of these patterns that that's going to occur, and then they take the trades, right? They believe it looks like an opportunity, but it's actually a massive mistake. So again, if you get a close back into the level, you want to take a buy, place your stop below the stop hunt, and then go for a minimum of 2 times risk. And if you've got a range, take your profit on the other side of that range. That could be a 3 to 1, a 4 to 1, etc. So if you'd like to learn more and get a real edge in the financial markets and learn how to trade this stuff in more detail, then come and join me in a circle. Click the button below, do it now, because you'll be glad you did.